welcome. You're watching Money, Money, Money. I'm Samira Abdi. The year is almost over, and you know what that means? You can no longer avoid planning your tax savings. It's the last window to plan your investments, but you needn't worry, because our two experts today, Parizat Serwala of KPMG India and Harshvardhan Roongta of Roongta Securities, join in today to arm you with everything that you need to know. Hi, thanks very much to both of you for joining in today. Parizat, I want to begin with you first, because this budget, there were a lot of changes and a lot of people are still not clear about what is the exact exemptions that they can avail and on what. So first up, could you just run us through what are the maximum tax savings that an individual is entitled for?
Sure. So this was the first budget presented by the Honorable Mr. Arun Jaitley, and a couple of tax savings if you look at it in terms of bracket changes as well. So there was a hike in the exemption limit of roughly around 50,000, which translates into a tax savings depending on the bracket you are in. Coupled with that, the crowded investment limit of Section 80C, which was 1 lakh per annum for the last couple of years, was also enhanced to 1,50,000 per annum. So as an investor or as a taxpayer, you had the added benefit of another 50,000 investment, which again translates into some tax savings. Then we had the interest on housing loan, which is a common feature for almost every taxpayer, which also was hiked up from around 1,50,000 to 2 lakh per annum. So these were some desirable, tax savings which were introduced in this budget as far as an individual taxpayer is concerned.
Okay, so as far as investments go now, there's an additional 50,000 that we need to worry about where to invest. So what's the advice then, Harshvardhan, on that front? Because should someone just first try to set off their EPF against this extra 50,000, or should the entire 1.5 lakhs be accounted for investment, not counting EPF?
Well, so there EPF qualifies for a deduction under Section 80C. So the idea is today you're now allowed to make investments up to 1.5 lakhs, and there are a couple of options available within that. So one is the EPFs, then you have your PPF that you make, then you have your insurance premiums that you pay. So a whole lot of things, the ELSS investments. The idea is, what should an investor do? Very clearly the objective is that if you can align your investments in such a manner that they help you solve your achieve your goals, at the same time help you save tax, then most certainly you should try and take the advantage. I'll explain this with an example. Suppose you have long-term requirements, say probably for your retirement, which is say 20 or 30 years from now. Most certainly you would invest into equity as an asset class to build that kind of corpus. Now if that is your goal and you wish to invest into equities, you have a choice to invest in ELSS schemes, the equity linked savings schemes offered by mutual funds. These schemes also invest in equities. So, and they also qualify for Section 80C benefits. So what an investor should do is align both of your goals and put in a product which solves the purpose. So you will also get tax benefits, at the same time you get the asset which you wanted to invest into.
That's fair enough, Harshvardhan, but let's try and break this down into the various components that are actually accounted for. Let me first start with home loans, because you mentioned that as well, right? There the exemption on interest has been raised to now 2 lakhs. But how does that work for people who might have joint loans? Is it 2 lakhs in total or 4 lakhs?
So there are also tax advantages in a marriage. So if you kind of take, if you have taken jointly funded the loan and you're paying the EMIs, then the exemption limit of 2 lakh on the interest is per assessee. It's always qua the taxpayer.
Okay.
So if a husband and wife are actually paying the EMIs and have funded the loan, then each individual taxpayer would be entitled to 2 lakhs. So there are tax advantages as well.
That's true. And the other part of that, Harshvardhan, is the people who want to claim HRA benefits. Okay, what happens in a case, say someone is living with their parents still? Is there any way they could legally be claiming this HRA exemption?
Well, very interesting here. If you're living with your parents, you're not really paying rent in that sense. Whereas your income, the salary that you get, includes HRA as a major component. So you're not technically eligible to set off or take the benefits of paying rent. What you could legally do within the framework is there are two different assessees. One is your parent. It could be a mother or a father in whose name the property is registered, and you're living with them. So they are different assessees, you are a different assessee. What you could do is, you could formally pay rent to your parents, in whosever name the property belongs. And then you can claim, take a receipt, pay the rent by check. So in that context, you are paying rent, and you can claim the deductions. What happens on the other side is that it becomes a rental income for your parents, in whoever name the property is, and they pay income tax as income from house property. So if there is a tax arbitrage in that sense, then most certainly you can do that, and I don't think there's anything illegal, really speaking, about it.
That's fair enough, actually. But Perez, I want to come back to you. The other, big component that takes away sometimes, or rather causes some pain, is DDT, or the dividend distribution tax. What's happening on that front? And is there any way for people to try and set this off?
So actually dividends are tax-free in the hands of the person who receives it. But yes, there is, when DDT is a tax on dividends which the company pays. So in that sense, your surplus which is to be distributed is reduced. So yes, I would say it's an invisible tax which sometimes the investor is not really able to fathom. So in that sense, and there are different rates prevailing, and it ranges from 15 to 29% as the case may be, depending on what the dividend is paid on, whether it's equity funds or debt funds. But definitely it's an indirect cascading to the individual investor, but per se the dividend is exempt in the hands of the individual.
But in this case, Harshvardhan, is there any way to try and set this off? I mean, if I were to choose the growth option of a mutual fund, would I reduce this DDT burden on my investment?
Well, you cannot really reduce the burden, but you can choose between a dividend payout option or dividend reinvestment, that comes under one category, and the other is a growth option. So depending on what which tax slab you're in, you can choose between the two. Now, for example, if you're in the 30% tax bracket, so if you're taking if you're opting for a dividend payout or a reinvestment option, 28.33% is anyways going to be deducted. So one option is that is getting deducted, dividend is tax free in your hand. Or you take a growth option and you pay 30% on that on a short-term capital gain, which is up to 36 months. Now, if you are in the 10% tax bracket, then most certainly you will go in for a growth option, because if the income that you generate, the capital gains that you make, the short-term capital gains, you're going to be taxed at 10%. Whereas if you had taken a dividend option, it was taxed at 28.33%. So it depends entirely where you're going to be, actually what is your existing tax slab. Then the question arises for long-term capital gains. There is where you have a choice to claim indexation benefits, and then there is a reduced rate of tax on that. So in case you wish to stay invested for more than 3 years, then most certainly you should try and look at a growth option.
I know you have never counted insurance as an investment, and nor should any of our viewers, but would you recommend that if someone already had a term plan, they had health insurance, should any part of insurance be paid for purely as a tax saving purpose?
In fact, sir, I would say none of your investments should be made keeping tax savings as the first objective. That's usually how people invest in India, but that's really not the way. You do not invest only to save tax. Invariably you will land up buying something which you do not need. So, because it's a last moment purchase, you will land up buying whatever is available to you. And whichever distributors, if there is a mutual fund distributor, he may ask you to invest into ELSS, which may not be aligned with your goals. And on the other hand, if you have an insurance advisor, he may ask you to buy an insurance policy, which again may not be. So the idea is, tax saving is an ancillary benefit that you get. As I said, you try and align it with your goals and your investment objectives, but insurance or any other investment for that matter should not be, tax saving should not be the only reason why you invest.
No, fair enough. Alright, that's fair enough actually, but we need to take a quick break here. We'll come back in a bit. We're not done with this, and it's not just tax saving, there's also IT returns that have to be filed. So all of that is lined up next. Do stay with us. We're back in just a bit. Hi, welcome back. You're watching Money, Money, Money. It's the end of the year, and it's the time now to plan for your tax saving purposes. Perez Sarwala of KPMG India and Harshvardhan Roongta of Roongta Securities are two experts. They've been advising us on one of the best investment options. So Harshvardhan, this time first to you, because we've spoken about EPF, we've spoken about insurance, some of the investments as well, and you've given very good advice that investments should not be done with the sole purpose just having to save your taxes. It has to be aligned with your goals. But if someone still has surplus, what are the top investment ideas that you're telling them about?
Well, there are a couple of options available. I would believe half a dozen options are available to choose from while you invest into ATC. Now, each individual will have different requirements. and there are different products which are aligned for different timelines. Like for instance, if you need something, say probably in the next 5 or 6 years, then probably a national savings certificate would be a product that you would invest into. If you need something, which you're willing to stay for 15 years or so, PPF is a good product to invest into. If you want to invest into something which is much longer in nature, then an ELSS scheme, which is an equity linked savings scheme, it's indirectly an equity investment. So that is a product you should go into. As a general rule, I would say you never try and ape somebody else. If a colleague of yours is investing into, say, probably an ELSS scheme, does not mean you walk into and simply start investing into ELSS. You have to first analyze what are your requirements, when do you want the money, and accordingly choose a product amongst the options available. So really speaking, there is no top investment idea. It's something that works for you. Sure. And that is good. No product is bad. It's just that you need to be fitting into the scheme of things.
That's true. But sometimes what happens is investments do go wrong, right? So if I've made, say, losses on short-term losses on stocks this year, is there any way for me to set it off against any other short-term capital gains or long-term gains that I may be having?
Yeah, so short-term capital losses can be set off against capital gains, whether short-term or long-term, and that's fairly clear as far as the law is concerned. It's just at times, the income tax department at the lower level tends to get into the source of the loss or the gain, because you have different rates of capital gains taxation, but we have enough plethora of judgments in favor of the assessee. So per se, if you file your return on time, then short-term capital losses can be set off against capital gains.
Okay, so when you say file your returns on time, you mean before the 31st of July?
That's correct. For individual taxpayers, largely people who have salaried income, the deadline for filing is 31st July for every annual year.
Well, Sumera, I'd like to add something on that. When we're talking about setting off your short-term capital loss against your capital gains that you've made, well, if you want to set it off, then the 31st July deadline may not be adhered to. You can, in the current situation, you can file your returns up to 31st March 2016. And you can set off the loss that you have against the capital gains. In case you do not have a capital gain, but you want to carry forward for the subsequent financial years, in that case you will have to file your returns by 31st July.
Okay, fair enough, but ordinarily, if I didn't have any of this loss or profit, didn't want to set anything off, ordinarily, when can a person, a salaried employee whose tax is deducted at source, what's the latest by which they need to file their returns?
Well, ideally you should adhere to the original timelines, which is 31st July. And in case you are unable to do that for any reason, well, you have time to go up to even March 2016. So you can file your returns
without any penalty.
Penalty, yeah, I think without any penalty, but March 2016 onwards there would be a penalty of 5,000 rupees.
Faizan, I want to talk a little bit about debt instruments now. Can the tax on that be actually deferred till I withdraw my investment?
So actually it depends on the nature of the debt instrument. By and large, as an individual assessee, what is the nature of accounting that you're following? Because in the income tax law, you do have a choice as an individual to either follow the cash system or the mercantile basis of accounting. What I mean to say is that let's assume you have a fixed deposit. You either offer the interest income which is taxable on accrual basis, which means year on year, or you offer it on cash basis, which is when you receive the accumulated amount on maturity. One of the two you have to offer it for tax. So in that sense, yes, debt instruments by and large, if you're following the cash method of accounting, you can offer it on maturity. However, if you have a debt instrument like NSC, then there is a provision in the law which says you have to compulsorily offer the interest on accrual basis. Very much depends on the nature of the debt instrument and the stream of income.
And finally, just to wrap this up, Faizan, what is Form 26A, and is it required for all individual assessees to actually verify their tax credit? I mean, what does it actually entail?
Yeah, you should. So it's a simple form actually which you can download from the NSDL website, and even today you can download it. It will give you a summary of all your tax payments, whether it's TDS, if you've paid advance tax, it will even kind of factor there. So it's a good way to check your taxes already paid or deducted, and if there are any mismatches between what you feel you've paid and between what you see on the 26 years, it will only help you to be proactively correcting those discrepancies. But it's something which every individual taxpayer can actually download from the website. Very
so
simple.
It's recommended?
Absolutely.
All right, on that note, thank you very much to both of you for joining in today and advising our viewers. Harshvardhan, you have to stay on. There's more left on the show. But Faizan, here's where we thank you. Thanks so much, and we hope to see you again in the new year.
Thank you very much. Yeah.
We need to take a quick break, but before we do that, here's our weekly question. Which is your instrument of choice when it comes to tax saving and why? Write to us at money@network18online.com. Tell us why and stand a chance to be a part of one of our future episodes. Do stay tuned. Coming up next is our viewer call-in segment, Can I Afford It? Welcome back. You're watching Money, Money, Money. Before we start answering our viewers' queries, let me hand it over to Manasvi Gilani, who joins us with Mythbusters.
Overseas travel insurance, something that requires utmost protection against, and hence important to bust some of the myths surrounding it. The first myth that needs to be busted is that cashless claims are not available for students traveling overseas. Students can easily avail this by providing their health cards in the hospital abroad. Insurance companies in India have associations with reputed claim settlement service providers in almost all countries who subsequently have tie-ups with majority of the hospitals in their respective countries. The second biggest myth associated with overseas student travel insurance is that it just covers the travel part. On the contrary, according to ICICI Lombard, a comprehensive students travel insurance provides a host of coverage to ensure hassle-free stay abroad. Coverage begins the moment you enter the airport to embark your journey. While the coverage offered by the university only covers medical expenses, the overseas student travel insurance provides maximum medical coverage, including insurance in case of an accidental death abroad. Non-medical coverage for emergencies like loss of checked-in baggage, passport loss or sponsor protection is also included. Lastly, many believe that travel insurance is not required if they have a health insurance policy. Health insurance policy will cover the treatment taken in India only, even if it does cover a continuity treatment abroad. Be aware of this and a fact that when you travel abroad, you are virtually unshielded without a travel insurance policy. So keep these pointers in mind and get on board relaxed.
Manasvi, thanks very much for that. Now on to Can I Afford It? If you're looking for a bit of extravagance in your life, well, we're the people to call and our expert will tell you if you can afford it or not. So joining us first up is our first caller, Sriram Naidu, who calls in from Chennai. Hi Sriram, what's your question?
Hi, I am Sriram Naidu. I am 34 years old. I have an income of 1.8 lakhs per month and my monthly expenditure is 40,000 per month. I have a home loan EMI of 35,000 per month and my total savings are worth 8.5 lakhs and I have adequate insurance too. I would like to know if I can afford to buy a new car.
Okay, how much is this going to cost you and how are you going to pay for it?
It is worth 6 lakhs. I will pay for it entirely from my savings. I can take a loan if required.
Alright. Harshvardhan, what do you think? Can we give him the go-ahead?
Yeah, most certainly. He has a monthly surplus of about a lakh of rupees, plus he has a savings of 8.5 lakhs. Most certainly he can go ahead with his car. Just a small bit of suggestion that he should just pay the down payment as a lump sum and take a loan for the balance amount, so that the EMI starts incorporating into his monthly expenses, and so it will be more on a financial discipline part of it. So most certainly yes, he can go ahead and buy his car.
Alright Sriram, enjoy your new car. Like Harshvardhan said, just use your cash for down payment and take a loan for the rest of the amount. Up next, Abha Prasad calls in from Mumbai with a query. Hi Abha, what's your question?
Hi, I am Abha Prasad. I am 27 years old. I have an income of 45,000 per month and my total expenses are worth 18,000 per month. I have total savings of about 2.3 lakhs and I do not have any insurance. I would like to know if I can afford to buy the new iPhone 6.
Okay Abha, so how much is this phone going to cost you?
It will be worth 62,000 rupees and I will pay for it from my savings.
Okay, ouch. Harshvardhan, this might be a tricky one. What do you say?
Well, I would not suggest that she should go ahead and buy the phone right now. The reason being, she has a monthly income of 45,000 and this phone in that sense is more than her monthly income, minor, even when we don't consider expenses. So at this moment I would suggest that the investment, because she just 27 years of age, it makes more sense to be more financially prudent rather than going for an expense like this.
Yeah, that's a good word actually, because Abba, there is really a time to be extravagant and there is a time to be prudent, and right now is the time for you to be prudent. Sorry, but for now your request is denied. Finally, we have an email query which has been sent to us by Pratik Shah, who writes to us from Aurangabad. Pratik says he's 39 years old, he's a businessman, he earns about 90,000 rupees a month. His expenses are roughly around 23,000 and he has managed to save 3.4 lakh rupees. So his question is, can he afford to take his family of 5 on a vacation to Goa? It should cost about 45,000 rupees and he said he'll pay for it entirely from his savings.
Well, most certainly, if you look at the monthly surpluses, this 45,000 rupees can be paid out of just 1 month's income. So he need not even dip into his savings. So yes, it's vacation time, and most certainly he can take his family out for the vacation to Goa.
Alright, Pratik, Happy New Year to you then. Enjoy your vacation to Goa. Harshvardhan, as always, thanks very much for joining in and advising our viewers. And viewers, do remember, keep writing to us at moneymoneymoney@network18online.com. You can also find us on Twitter. Write to CNBC TV18 News and you can use the hashtag money. And remember that you can also catch all our previous episodes by logging on to youtube.com. Thank you so much for watching. We'll see you again next week.